UK house prices were meant to hold steady in December 2025. That's what everyone expected. Most forecasts said the same thing. No drama. No big moves. Instead, they quietly fell. No warning. No loud headlines. Just a small drop that caught almost everyone off guard. And that's exactly why this matters. Right then, let's slow this down. Because a small fall at the wrong moment can matter more than a big drop at the right one. In December 2025, UK house prices slipped by around 0.4%. On its own, that doesn't sound massive. You could scroll past it without a second thought. But context matters, mate. That fall arrived at the exact moment the market was meant to be holding steady, not booming, not falling, holding. Instead, annual house price growth slowed to just 0.6%, the weakest pace in almost 2 years. Not a crash, not panic territory, but a clear change in direction. And in housing, direction matters more than speed. Because when prices stop rising, pressure doesn't disappear. It moves. Quietly. Sideways. Into parts of the system most people aren't watching yet. Now hang on. This isn't about calling a crash. Not yet. It's about understanding how housing markets actually turn. At the start of January 2026, Nationwide released its latest house price index. Most people saw one line. UK house prices fall in December. Then they moved on. But underneath that headline was something more important. Month on month, prices slipped by 0.4%. Year on year, growth slowed to 0.6%. That number mattered because it was the weakest growth since April 2024. And that surprised analysts. Through most of 2025, the housing market looked surprisingly resilient. Interest rates were high. Living costs were tight. Uncertainty was everywhere. Yet prices didn't fall. They didn't surge either. But they held. That stability created a risky assumption that the market had already taken the hit and adjusted. That maybe the worst was behind us. December quietly challenged that belief. To be fair, one monthly dip doesn't equal a housing crash. December is always slower. Fewer buyers, fewer completions. Seasonal effects matter. But when seasonal weakness lines up with the weakest annual growth in nearly 2 years, that's not just noise. That's a signal. And here's the part most people miss. Housing markets don't turn loudly. They hesitate first. They pause. They slow. They wait. That hesitation spreads before prices ever move sharply. So why did this happen? Right now? On paper, conditions should have improved. Interest rates had started easing. In December, the Bank of England cut the base rate from 4% to 3.75. Mortgage rates followed. Slowly, but enough to ease affordability. Just a touch. So why did prices still fall? Because housing doesn't move on interest rates alone. It moves on confidence. And by late 2025, confidence was tired. Buyers weren't rushing. Sellers weren't convinced. Most households were waiting, watching, holding back. From a distance, the market looked calm. Up close, it felt a bit fragile. Prices were still higher than a year earlier, but momentum had faded. And momentum is everything. When momentum fades, behavior changes. Buyers stop stretching offers. Sellers test lower prices. Sales take longer. Not loudly. Not dramatically. Just slowly. That's how pressure builds. Without headlines. Now here's where it gets interesting. This slowdown isn't hitting everyone equally. First-time buyers feel a strange mix of relief and doubt. Less competition. Fewer bidding wars. More breathing room. But also a question. That changes everything. If prices aren't rising anymore, why rush? For existing homeowners, the feeling's different. Equity stops growing. Remortgaging gets tighter. Plans based on rising values start looking a bit optimistic. And in areas never fully recovered, that's rough. For renters, nothing feels cheaper yet. Cooling house prices don't automatically mean lower rents. Supply's still tight, demand still strong. So pressure just moves sideways. For builders and developers, this is where caution kicks in. Homes take longer to sell. Incentives creep in quietly. Projects slow. Not because demand vanished, but because certainty did. Banks noticed this early. Mortgage approvals haven't fallen off a cliff, but lenders are watching closely. Because when confidence doesn't return, stress doesn't explode. It accumulates. Quietly. A lot of people hear this and jump straight to 2008. That's understandable. But this isn't a repeat. Back then, credit froze. Defaults surged. The system snapped. Most households are still paying. Lending is still happening. The system's working. More slowly. This isn't a collapse story. It's a transition story. From growth to hesitation. From certainty to calculation. And those shifts matter. Because housing runs on belief. Once people stop assuming prices always go up, everything changes. Not overnight, but piece by piece. That's why December 2025 wasn't just another data point. It was a signal. A quiet one. And those are usually the most important. Right then. Now we need to talk about confidence. Because housing markets don't break when numbers fall. They break when people stop believing the numbers will save them. And that's exactly what started happening. Towards the end of 2025, on the surface, things looked fine. Rates were easing. Inflation was cooling. Wages were finally moving a bit. But confidence didn't come back. And that confused a lot of people. Because in theory, this was meant to be the turning point. Lower rates, better deals, more breathing room. Instead, buyers hesitated. Now hang on. This wasn't fear. It was calculation. People weren't panicking. They were thinking. And that's actually more dangerous. For a housing market, when buyers panic, they rush. When they calculate, they wait. By late 2025, that waiting spread everywhere. First-time buyers stepped back. Not because they couldn't buy, but because they didn't need to rush. Monthly payments still felt heavy. House prices weren't rising fast. So the urgency disappeared. And once urgency goes, transactions slow. Quietly. Existing homeowners felt it too. Many were coming up to remortgage. And the maths wasn't friendly. Even with rates easing, payments were still higher than a few years ago. So people tightened budgets, delayed moves, put plans on hold. That hesitation doesn't show up in headlines, but it shows up in behavior. Viewings dropped, offers took longer, chains collapsed more often, estate agents noticed first, phones rang less, listings sat longer, and conversations changed. Instead of, how fast can we sell? It became, what if we wait? That question can freeze a market. Now let's talk about sellers. Because sellers held the line for as long as they could. Nobody wanted to cut prices. So instead of reducing, listings disappeared. Homes weren't sold. They were withdrawn. That's a classic sign of a market losing confidence. Not a crash. A standoff. Buyers waiting for prices to fall. Sellers waiting for confidence to return. And nothing moves. While both sides wait. This is where pressure builds. Without noise. Now bring lenders into this. Banks don't panic early. They watch. Mortgage approvals didn't collapse. But criteria stayed tight. Affordability checks remained strict. Stress tests stayed cautious. Because lenders don't care about headlines. They care about risk. And risk, by late 2025, felt unresolved. Builders felt it even faster. New homes take confidence to sell when buyers hesitate. Developers slow. Projects pause. Incentives appear quietly. Completion timelines stretch. Not because demand vanished, but because certainty did. And once builders slow, supply tightens later on. That's how today's hesitation becomes tomorrow's imbalance. Now here's the bit most people underestimate. Confidence isn't logical. It's emotional. Once buyers stop assuming prices always go up, they behave differently. They ask more questions. They negotiate harder. They walk away more easily. That shift alone can flatten prices without any bad news. Online, you could feel it. Housing forums turned cautious. Finance threads became analytical. Not doom, not optimism, just waiting. People stopped asking, how do I get on the ladder fast? They started asking, is now even the right time? That's a huge change, because housing runs on belief. Belief that time is on your side. Once that belief weakens, the market slows before it falls. And that's where we are now. Not in crisis, not in recovery, but in a confidence gap, a space where decisions stall and momentum fades. And in housing, mate, momentum is everything. Because when confidence goes quiet, prices don't need to crash. They just stop moving. Right then. This is where people usually ask the big question. So what happens next? And more importantly, is this about to get worse? The honest answer is, it depends. Not on one headline, not on one rate cut, but on a few pressure points that are lining up quietly. Let's start with mortgages, because this is the slow-moving part. Most people underestimate. Over the next year, millions of UK households will come off fixed-rate deals. Deals agreed when rates were low, really low. For many of them, the jump won't be dramatic, but it will be uncomfortable. Monthly payments rise, budgets tighten, choices shrink. Most people will cope. But coping isn't the same as confidence. When households feel stretched, they stop making big moves. They don't upgrade. They don't relocate. They don't take risks. That alone slows a housing market without any panic at all. Now let's talk about regions. Because the UK market doesn't move as one. Some areas held up well through higher rates. Others never fully recovered from earlier shocks. In those weaker regions, even small drops matter more. Buyers hesitate longer. Sellers dig in harder. Transactions dry up faster. And that creates pockets where prices soften first. Quietly. That's usually how broader shifts begin. Not everywhere at once, but unevenly. Now builders are often the early warning system. When demand slows, they feel it first. Not through headlines, but through footfall. Sites get quieter. Sales suites slow down. Incentives creep in. Completion dates stretch. New projects get delayed. None of this screams crisis. But it tells you something important. Confidence isn't back. And without confidence, supply decisions change. That can store up problems for later. Banks see this too. Lenders aren't panicking. They are cautious. Affordability rules remain tight. Stress tests stay conservative. Because banks don't care about optimism. They care about risk exposure. And right now, risk feels unresolved. This brings us back to the comparison everyone makes. 2008. It's tempting. It's familiar. But this isn't the same setup. Back then, credit collapsed. Lending froze. Defaults surged. Lending still works. Most people are paying. There's no sudden snap. What we're seeing instead is a grind. A long period where growth is limited, confidence is cautious, and movement slows. That can last longer than people expect, and it can reshape behavior just as deeply. People adjust expectations. They plan differently. They stop assuming housing is a one-way bet. That mindset shift is powerful, because once it sets in, it doesn't reverse quickly. So where does that leave the UK housing market? Not on the edge of collapse, not bouncing back either, but stuck in between. A phase of adjustment, where prices don't soar, sales don't surge, and everyone waits for clarity. And here's the thing, mate. Markets don't like waiting. Waiting creates pressure. Pressure creates change. Not all at once, but steadily. That's why moments like this matter. Not because something dramatic is about to happen tomorrow, but because behavior is already changing today, quietly. If you're watching the UK property market, this is the moment to stay informed, not alarmed, because the biggest shifts rarely announce themselves. They unfold slowly, while most people wait for something louder. If you're in the UK, share what you're seeing locally, and subscribe for calm, clear breakdowns of how the housing market is really changing.